Okay, welcome everyone, and thank you for joining us today for our program, A Rapidly Changing M&A Market, Current Trends and Deal Points. My name is Ned Turnbull. I'm a partner on the M&A team at Williams Mullen, and I'm joined by a few of my M&A team members, David Lay and Aaron Spencer. David is a partner in our Richmond office, and his practice focuses on lower middle market M&A and financing transactions, including those in the technology, life sciences, logistics, and services industries. Aaron is a partner in our Raleigh office, and his practice focuses on a wide range of M&A transactions, including those in the IT, healthcare, and manufacturing industries. Today's program will cover drivers and current trends in M&A transactions, including how the M&A market has changed over the last 12 to 18 months, how current conditions are impacting specific deal points, and what trends we anticipate seeing moving forward. Before we get started, I'd like to go over a couple of housekeeping items. At any point during the presentation, you may submit a question by using the Q&A button at the bottom of your screen. We will turn to questions at the end of the presentation. If you are having any audio or technical problems, please use the same Q&A button and our helpful marketing folks will get those resolved. Finally, no need to write down everything you see in this deck. You will receive a copy of the presentation materials by email later today. Okay, let's get started. Aaron, thanks again for joining us today. I'm going to turn to you first and ask for you to set the table for us. I think it's an understatement to say that the last year or so has been unusual for all of us in many different ways, and I think that holds true for M&A transactions as well. I know from my vantage point, it felt like the bottom was going to drop out last March and April, but that's not exactly how it played out, and I think that the way it played out over the last year is still affecting us today. So maybe you can let us know what some of the overall trend lines in M&A transactions that you've seen over the last year are.
Yeah, thanks, Ned. And you're right. It has been an unusual and I think interesting year, to say the least. And I think we need to go back just a little bit further in time to get the full picture here. As everyone knows, a lot of deals stopped or were paused as COVID spread and the country started going into lockdown in March and April of 2020. Probably a majority of deals that were in the early stages at that time, like at the letter of intent or preliminary diligence stages, were stopped or paused. There were some later stage deals that were still completed, but those were completed oftentimes on less favorable terms to the seller than had been originally negotiated. And that trend continued during March, April, and May of last year. Some of those deals died and never came back, but a lot were revived. And in the summer of 2020, things slowly started to come back to life. And during that early resurgence in the summer of 2020, there was, and understandably so, still a lot of uncertainty in the market. There were still lots of buyers with dry powder, but many of them sat on the sidelines longer than others to see how the health crisis was going to unfold and how the economy was going to perform. A smaller group actually accelerated some deals, though, and acted opportunistically to snap up some targets in hot spots that were thought to be well positioned under those unique circumstances that we were dealing with back at that time. But during that short pause and during that relatively short period of lower volume that followed that pause, the trends we were seeing at that time, as you would imagine, tended to be more on the pro-buyer end of the spectrum, primarily because competition just wasn't as fierce and there was still, a fair amount of an uncertainty to deal with. Some sectors were hit harder than others early on. Examples include restaurant and hospitality, travel, brick and mortar retail. Those industries were hit exceptionally hard early on and took longer to recover, but activity has picked up in those sectors in recent months. Other sectors thrived under those circumstances, with so many people working and generally spending more time at home, like the likes of online retailers, delivery services, home and garden retailers, and gaming companies, to name a few. But as the health crisis outlook continued to improve and the US economy demonstrated resilience, the markets heated up pretty quickly and transitioned to very friendly or seller-friendly terms. The valuations rebounded and sellers benefited from the increased competition with more and more favorable deal terms being offered by both strategic and financial buyers. And by the end of 2020, the market was really booming again, and that trend has really continued through where we find ourselves today, a little more than halfway through 21. So we'll touch more on this a little later, but we expect deal volume to remain strong through the end of this year, even as valuations continue to stay high. After the flurry of deals in the last several months, private equity powder, dry powder, it may not be as high as it was at pre-pandemic levels, but there's no question that there's still a lot of dry powder and a high demand for quality assets. And finally, one additional item here that may be worth noting for its potential to influence the market is that some sellers who may not have been quite ready to sell seem to be jumping into the market and accelerating their timelines because of these favorable conditions that we continue to enjoy. So that's sort of an overview of the recap of what we've seen in the markets the past year or so.
That's great. Thanks, Aaron. Appreciate the insight. David, we're going to turn to you now, and I'd really like to ask how some of these overall trends that Aaron described have been impacting specific deal points. I feel like we've spent a lot of time over the last year talking a lot about very COVID-specific aspects of our transactions, but those have either at this point really become baked in or fortunately become irrelevant. So what are you seeing now in terms of negotiation of specific deal points?
Yeah, thanks, Ned. You're right. We have seen these trends impact quite a number of deal points. Today, I wanted to highlight four. Earnouts, the use of buyer equity as purchase consideration, the use of rep and warranty insurance, and indemnification terms. First, earnouts. As most of you probably know, an earnout is a mechanism by which a portion of the purchase price is calculated after the closing by reference to the target company's performance over some defined period after the closing. For instance, by reference to the EBITDA of the target company over a 1 or 2 year period after the closing. During the pro-buyer portion of 2020, we saw an overall increase in the usage of earnouts in order to bridge valuation gaps. Essentially, the pandemic was creating more uncertainty about target companies' prospects and their ability to weather the pandemic and how they would come out on the other side, which in turn created more uncertainty about valuations. In deals that contained earnouts, we also saw an increase in buyer-friendly terms. For example, we saw longer earnout periods, more in which the earnout period was greater than a year and fewer in which the earnout period was a year or less. We also saw more earnouts calculated by reference to EBITDA, which is more easily manipulated than, for instance, a revenue target. And then we saw, in turn, fewer earnouts calculated based on revenue. We also saw an increase in the overall portion of the purchase price allocated to earnouts. Currently, I would say that our experience is that earnouts, both in terms of terms and frequency, have largely returned to their pre-pandemic terms. During the same pro-buyer portion of 2020, we also saw an increase in the use of buyer equity as purchase consideration. This was consistent with buyers looking to de-risk deals by employing or deploying less of their cash and incurring less debt. For some deals that contain rollovers, we also saw the rollovers representing a larger percentage of the total deal value than we would normally expect to see. And I will note here that last year, some of our colleagues had a webinar as part of the same series on tax-free rollovers, which you can find on the Williams-Mullen website under our M&A webinar page. Like with earnouts, the use of buyer equity as consideration has largely returned to pre-pandemic terms in our experience. As the environment trended more seller-friendly later in 2020 and into this year, we saw and continue to see an increase in seller-favorable usage of rep and warranty insurance, which ripples through the indemnification terms. All deals are unique, of course, but some examples of pro-seller terms that we've seen include the buyer paying all of the rep and warranty policy premiums, buyers retaining responsibility for all of the deductible or retention under the rep and warranty policy, such that the seller would not have to risk coming out of pocket for claims before the coverage under the policy kicks in. We've also seen deals in which there's been a reallocation of the risk for breaches of reps and warranties that aren't covered by the policy. Instead of the seller being responsible for those types of excluded reps, which is more typical, we've seen more deals in which buyers have assumed that risk, other than in the case of fraud. There have also been many more deals in which the sellers have not retained any residual exposure for breaches of reps after the rep and warranty policy limits are exceeded. And we've seen more what we call no survival deals, essentially deals in which the buyer's sole recourse for breach of all reps and warranties is recourse against the rep and warranty policy, again, except in the instance of fraud. Finally, we've seen a continuation of the trend toward shorter survival periods for buyers to bring claims for breaches of reps and warranties. This trend has been occurring for several years, and in our experience was largely unaffected by the pandemic. These days, the median survival period for breaches of reps and warranties is closer to 15 months, whereas only 5 years ago or so, it was more in the 18-month range. Ned, I'll turn it back over to you.
Sounds great. Thanks, David. Guess we've got a few minutes left, so before we adjourn, I'd like to turn it back to both of you and ask, given the current drivers in the market, what trend lines do you anticipate seeing for the rest of the year? Aaron, maybe you can give us your insight first.
Yeah, we expect M&A activity will continue to be strong through the end of this year for a variety of reasons based on things that we're seeing and hearing right now. Because the market's been so active recently, like we said before, there may not be as much dry powder as there was pre-pandemic, but there's still a lot. Interest rates remain low, so capital remains plentiful, and we think this will continue to fuel activity. We also have to keep in mind that we're still in somewhat of a recovery mode as the economy shakes off the effects of the pandemic. Companies are still working through backlogs, inventory and material shortages, delivery delays, and things of that nature that have created temporary issues in their numbers. So we're still working out of that stage as things continue to normalize. But the bottom line is we think things will continue to remain strong absent some new significant developments. But there are some things that could rain on the party and change that assessment. And examples include the heightened fears about rising interest rates, increases in the type of large-scale ransomware cyber attacks we've seen in recent months, lagging emerging markets, risks in those markets that are related to slow vaccination rollouts, and COVID variant risks, which seems to be top of the newsfeed these days. And finally, there's always the potential for geopolitical problems, like some type of an escalation with the situation between China and Taiwan, or some flashpoint in the Middle East. But bottom line is we think things will continue to stay strong unless something significant happens to affect that.
Yeah, and I agree, Aaron. Assuming there's not too much rain on the parade, that things will continue to be strong. Some of the industries in which we expect an especially positive outlook include technology, especially IT companies, where the median EBITDA buyout multiple last year was approximately 20. So IT companies and technology companies that facilitate or benefit from remote working. Healthcare, which has been hot for quite some time now, we expect to continue to be hot, including healthcare tech companies that support telemedicine. In addition, B2C companies, infrastructure-related companies, and hospitality companies, all probably for obvious reasons associated with stimulus funds and the continuing emergence from the pandemic. Ned, back to you.
That's great. Appreciate your insights as always. And that is it for our presentation today. It looks like we are out of time. So if you asked a question and we weren't able to get to it, apologies, but not to worry. We will reach out directly and make sure we get you the information you need. Thank you for attending today, and have a great day, everybody.